Learn Accounting podcast by Professor Accounting. This is episode 7, Income Statement, Trading and Profits Account Layout. Let's start first looking at gross profit and net profit. First of all, gross profit is calculated in the trading account, and it is the excess of sales revenue over the cost of goods sold in a period. The trade account is the top section, the first section of the income statement, and when we calculate net profit, this is calculated in the profit and loss, which is the second section in the income statement. Net profit is what is left of the gross profit after all other expenses or overheads have been deducted. Let's look at this layout first of all of the trade account. Now this is only one example which generally students use as a guide to completing their final accounts. Teachers use this, and an exam board opts for this method, but it's again, there's a few variations between the layout, and there's no prescriptive layout that an exam board expects. So if we just look at this first example, this is only the trading account section. This is for sole trader final accounts, and title is important, so you need to have trading and profit and loss account, or the new title, which is income statement. And you can, in this case, they've got of and the name of the sole trader, and it's for the year period ended, or the period ending, or the year ending, and the date. So for example, the date could be the 31st of December 2011, and the date would go in full. We typically adopt a 3-column approach in terms of the numbers, and the column on the left which has got all the details, and we just start at the very top with sales. So there's no correlation between debits and credits in the final accounts. In this stage, we just use the values from the trial balance in terms of debits and credits, but there's no debits and credits in the trading account or any other section of the final accounts. So sales are our first value, and we put it into the far column, the third column. We then take away sales returns, or returns inward, which is also called, and that goes next. And we tend to, when there's a deduction, we use brackets to illustrate that. Brackets, parentheses, can mean minus, it can mean deduction, it can mean negative numbers, so we've got to be careful what it does mean, but generally brackets used in final accounts means to take away, to deduct. So you'll see in a moment another layout, which is my preferred layout, which is a bit more detailed. That obviously uses, it would use brackets if it was written, but if it's typed, then depends on what you're using. If you're using Excel, sometimes you type a number and it doesn't take brackets. So we've got sales, we get the sales returns, or the returns inward, and that gives us net sales. That's the top section complete. Then we start with opening stock, and this section is the cost of sales. It's not written on here, it'd be on my layout, or the cost of goods sold. So the first element is the opening stock, and that tends to go in the middle column, or is in this example anyway. Purchases next, and what we're doing while we move back to the left column is we're working out what's called net purchases. So net purchases, there's a couple of ways of working out net purchases. In this example, it's purchases, and it's got carriage in, which is carriage inwards, and that is the delivery cost on buying or transporting the purchases we've bought during the period to the business. So it's like delivery cost, but it relates to stock coming into the business. So that is a cost of the sale, so it's a positive value, it's added to the purchases. Then there's less purchase returns, so less indicates we're taking away. Purchase returns, goods we've returned back to the supplier for whatever reason, faulty, maybe we've ordered too much, maybe the product's out of date, for whatever reason. So that's the return. So if it's being returned, it's not part of the cost of sale or the cost of the goods sold. So that is deducted, it's taken away. So if we do the maths on those numbers, in this case crosses, we would get an answer which is net purchases. So I won't go too much into that because I'll show you a slightly expanded version of what I use shortly. In this layout, the values move to the middle, then they do a subtotal, and that is opening stock in the middle plus net purchases to give that subtotal. After that, they've got less closing stock. Now, less closing stock, we're taking away the stock that's remaining at the end of the period, because it's very unlikely that a business would actually sell all their stock that they had originally and what they bought during the year in terms of general selling, we're always left with some stock at least left over. If you're doing business studies, or you know business studies, typically can be quite dangerous to actually sell all your stock, to run out of stock, and obviously disappoint loyal customers if they were to place a further larger order. So less closing stock is also a deduction, and that's coming away from the subtotal that is in that middle column. And the last section there is to work out the cost of goods sold, so that closing stock comes away from the subtotal, and the answer goes in the credit in the far column, the right column, which is labelled here as B, or in column B, and that's cost of goods sold. So that is the total cost of goods sold, and then the last step for this trading account is take that away from figure A, which is the net sales, and that gives us gross profit. So in this example, this is net sales minus cost of goods sold, which will give you gross profit. Okay, let's move on to the next section, which is the P&L. So the profit and loss account, this is just going underneath the trading account, as you've seen, straight underneath. If you were doing extracts of these individually, then you would obviously put relevant titles and call them extracts. Sometimes in OCR they ask for some mini extracts and so on, but more marks, generally most of the questions, both exam boards, AQA and OCR, they ask for a full trading and profit and loss account, which is the income statement. So in the profit and loss account here, it's one account, the profit and loss account, but there's two elements to it. There's an income side and an expense side. So at the very top we have income, so other income, and this is another way, or other ways for a business to generate further income. Their main income, obviously as you've seen, is from sales. Their core income, their main income, is from sales. So as you can see some examples here, how else can a business generate extra income? Well, we've got discounts received. So I'll briefly go through these. We can go through terms, I suppose, later, but just generally, here are other ways of making income. Discounts received, which is a cash discount, a settlement discount, and this is a discount received from a supplier for early payment. So if we pay within an agreed amount of time, a discount of say 2% or something relatively low is given back to us as a business. So it's an incentive to pay early. So that betters the creditor's cash flow and obviously helps us in terms of overall paying less. We've got a reduction in provision for doubtful debts. So that's where the change in provision has fallen during a period compared to the last period. Again, these need to be explained in individual podcasts. Specifically, this is, again, if you've been learning this since the start of the year or September, then again you know what I mean when we're revising this. So generally, I'm just going to go through this in terms of a layout. Profit on the sale of a fixed asset. Well, the profit element of that, profit on the sale of a fixed asset. We tend to say profit on disposal. Sale is not wrong, but disposal is the word we use when we are selling a fixed asset. Sale tends to be used when we sell stock, but it's obviously other income, and then they've got their income there as just mentioned for any other type. So I'll go through some more examples in my layout as to what other income could be. So look at where that's positioned. There's no pound signs here because it continues on for the previous example. We are using two columns, but the first column is there, but it's just not used. So the other income will just be listed in the far column, the far right column, and then simply listed and added to the gross profit that we've calculated in the trading account. So you've got there D is all the income, E would then give you gross profit plus other income. Then we go on to the expenses, and you've got a list here. This layout decides to segment the list into obviously a section of expenses and then other items in terms of expenses. It's not necessary to do that. It's not there's no additional marks for doing it, but what is quite nice is that the understanding of it, whereby all of the calculations and the adjustments that you would do in OCR papers and AQA papers, they tend to be more marks available for adjustments like calculating the provision for depreciation, calculating a loss on disposal of a fixed asset and so on, the bad debts to write off, increase in provision for doubtful debts. Those you do get a little bit more marks. So that calculation extra items have gone at the bottom of that list. So you've got a list there of expenses, just to name a few. You've got rent, that obviously is rent payable. You've got business rates, you've got telephone, salaries, wages, and so on. Discounts allowed as well, and carriage outwards. There's a range there. I'll show you more in a moment. So we list all the expenses, and it's in the middle column. We put all the individual expense, and we total them at the end, underline it, total it, and put it into the far column. And it needs to be in the same column as we have here, which is where you've got letter E, and that is showing that value would be gross profit plus other income. The reason why is because that's what we're going to take the expenses away from. So we take the expenses, in this case, total expenses, away from that value, and you would arrive at net profit. Now, don't forget, obviously, some businesses, your answer could be negative value, so that would be a net loss. It's not indicated here, but just to bear that in mind. So I've just put there an exhaustive list. So by all means, there's so many expenses that a business could have. In the exam, AQA, you probably have as many as this. Maybe OCR, you have a few more. Just depends on the actual papers. So I'll just say there, see my sheet, what is what. So I've got a document I'll show you, which is a list of, quite an extensive list of different expenses and different items for income as well. Okay, so if I just move on to my layout, here using Excel. So this is a template. This is my layout, or a layout that's got a bit more detail in. So if you just have a look at this and compare, I call it the income statement. You can still obviously get away with saying trading and profit and loss account, and there's nothing wrong with thinking about that, calling it that, because it's good to break it down into the two parts. But it is now officially called an income statement. It is for the year ended, and there's a date. So nothing to scan through some of these in terms of a layout. So we've got sales, we've got returns inward, which is sales returns, and it's deducted, and you get net sales. Label title, so cost of sales or cost of goods sold is the title. Opening stock, purchases, and this is where it starts to change a little. This is quite useful for an examiner because, for example, when you're writing this for an exam, because you're clearly labeling what's called drawings. Now, yes, drawings goes in the balance sheet. You may be thinking that, why is drawings there? It goes balance sheet. Well, this is a particular type of drawing, and this is any entry you make here relates to any of the adjustments that you have to use and deal with in an exam, and it only relates to when the owner takes out goods for their personal use. So because it's a drawing of goods, it's not a drawing of money, a drawing of cash or anything like that, because that would definitely go into the balance sheet. But this element here is you'd have this entry here whenever it's mentioned that the owner takes out goods for personal use. And what is happening is it's basically this value, whatever it is for drawings, it's, you can see brackets, it's been taken away from what you bought. So a little bit further on that, it's if this is a business that sells bikes, and the owner would like to have a bike for himself, he's not going to sell a bike to himself, because if you sell a bike to yourself, as in an actual sale, there's an element of profit in that sale. So who gets the profit at the end of the day or the end of the period? Well, that's the owner. So basically the owner will take the good and buy it at cost price. So we make a drawing, and the drawings is removing one of the products, one of the bikes, if that's the example, at cost price. So that's being deducted. Just to mention on this, whatever value does go in here for drawings, it will increase the total drawings. So if there is, typically there will be some drawings of money during the year, then that'll be in the trial balance. If this was a value, say £1,000, and there was £10,000 of drawings in the trial balance, then the drawings value in total would now be 11,000, and that goes into the balance sheet, which I'll show you after the income statement in the capital section. We've got returns outwards. So this is, again, we've seen this, that's deduction, that's reducing purchases by returning goods to the supplier. We've got carriage inwards. So carriage inwards, in this case, carriage means delivery. It's transportation costs. But it's inward, so the word inward talks about, or think of inwards as being the direction of the stock. So stock is coming into the business, so it's the delivery on getting stock into the business. Think of it that way, because you've also got carriage outwards. So the delivery on stock leaving the business, i.e. linked to sales. It doesn't go next to sales, it goes in expenses, which you'll see. You must have saw in the first example, you see again in this one. But carriage inwards is a cost of sale. So it is a positive value, and it is added to the purchases whereas drawings and returns outward are deducted. So if we do the maths on that, we get a next value, and that goes into the middle column, and that is our net purchases. So you, in this already here, this section here, the cost of sales, we've got net purchases being calculated, just with some extra, obviously, details there. It's not essential that you write the word drawings into value. Some people, they just reduce the value for purchases here, and they just put an answer in brackets somewhere in here. Something like when they do, like if they're working out or something, they do it like this and show it there. As long as you actually show some evidence that you've adjusted for the drawing, then you're going to get marks. Moving down, closing stock next. So we've got net purchases here, and we've got opening stock. Now this layout, which is what I prefer, within accounting you streamline accounting, you try and make things a bit easier. So what I don't do is I don't do a subtotal. So I'll do the maths all in one go. So the closing stock is a value here. Again, very common to have closing stock at the end of the period. So I would do opening stock, I would plus the net purchases and minus closing stock, and the answer goes in here, which is the cost of sales. And you're moving it to the right. You always move to the right of the account. So, and it's the reason why as well is we want cost of sales to be under the sales, net sales in this case. So cost of sales minus net sales will give you gross profit, which is what we got before. Moving further on, let's look at the so that is the trading section. You obviously when you finish gross profit, that's the trading account complete. We then start the P&L section. Now, yes, the P&L, if you did a P&L, you have to start with gross profit, but all the income and all the expenditure will go into the P&L. So here's a few examples, and again, look at the layout. It's consistently in the far column now for the other income. So discounts received, again, I'll explain that. Discounts received is it's a cash discount, a settlement discount, paying off an amount you owe. In this case, business, are paying a creditor, a supplier, and if we pay within a certain amount of time, we will get a discount for paying for early payment on our account. And usually, I mean, they're relatively small, sometimes 1% of the value, 2%, 2.5%, 3%. It's nothing significant, but it's basically if you pay a little bit sooner than agreed originally, we can get a little bit of money back. And that benefits the supplier because they get better credit control, better cash flow, better inflows of cash. Decrease in provision for debts. Again, I've mentioned that in the previous one, but again, it needs more. I need more time to go through that rather than run that. Just do the layout. Profit on the disposal again. So look at the language I'm using. Disposal means the sale of non-current assets. That's the new terms for fixed assets. It goes in the far column. Commission receivable. So again, you might again look at commission examples of what that is. But a clue there is anything with received or receivable is other income, and that again goes there. Add them up, and by adding up we mean gross profit plus the other income gives you a new total. We don't call it a name, but it's gross profit plus other income. Expenses. Middle column for expenses, all go in there. Now you don't have to write them with a bracket on every single time. I just did it to illustrate that it is a deduction. So all of these are numbers, just leave them as positive values if you wish, but at the end this number has to be not a minus, but it's a deduction because it's going to come off, taken away from this value here, which is the gross profit after including all other revenue, other income. So just a few expenses there. Again, you can see the list, all relevant. Obviously, if you've got a loss on disposal, just go up. You're not going to get a profit on disposal in the same account. You kind of it is unlikely in an exam. In real accounting, it is possible in a way because it could be two separate non-current assets. Maybe one is a van that you've sold and made a loss on, and then maybe this one is a machine and you've sold it and made a profit. So it is possible in reality, but you will not get one in your exam. Discounts allowed, sundry expenses, other operating costs, general expenses also known as bank charges. So that's an interesting one for AQA. If you're charged fees or penalties for late payment or going overdrawn, that is an expense. So it goes. So there's the list, and move them all to the total to the far column, and then you take it away. I've just mentioned. So don't forget your answer. Net profit is the value. If it's a net loss, then it's in brackets, which is the value there. Okay. So that's the that's a little bit more extensive in terms of, especially the trading account, a bit more extensive. let's move over quickly to the balance sheet. I'll just show you a balance sheet layout as well, just to go over here. So balance sheet as at. So remember, it's a snapshot in time. It's at a particular date. So it's usually the same date as the income statement, but it is for that day. So we've got 3 columns again: cost, ACDEP, NBV. Must have heard of these by now. So just, cost, obviously it's what you paid, the receipt value of what you've paid for your fixed assets, your non-current assets. ACDEP is the, just move over, ACDEP is the accumulated depreciation, and which means the total depreciation to date. So it's for every year or for the whole period, useful life you've owned your fixed assets. That's the total amount of depreciation you've accumulated, charged in P&L, every single P&L up until this point in time. NBV stands for net book value, which means the market value, which also means the expected current sale value. So if you can see that just there, let's move in a bit, expected current sale value. So that's what you might expect to achieve if you sell it on the market. Obviously the economy, everything being okay with the economy. Let's move. So that's fixed assets. So the structure here, you list your fixed assets. There's no particular order for your exam, but we tend to put these in order of the least likely to sell. So premises, obviously, unless you're in a lot of trouble in your business, you would not sell your premises. You'd probably sell a motor vehicle before your fixed fittings, before your premises. So there's a little an order that we do tend to like, but no marks for it in an exam. Cost goes in, ACDEPs go in, and BV. Now the layout here is the 3 columns. Really, they only set up this section only. So when you total up the 3 columns, look at the layout. Long line for the top, and then the bottom, you just underline the bottom twice to close that off. This one, the NBV, total NBV value, you actually need to use further down the page, which I'll show you. So you leave it not underlined. That's good notation, good presentation skills there. Current assets. So obviously current assets here. If we look at layout, we've got stock. So we start with stock. Don't know why there's a gap there. I don't need to really leave a gap, just make it closer. Now with current assets, here is this section here, so just hide it. This section, there is an order here which examiners, boards do like. It could be an order. This is the order of liquidity. So liquidity is talking about how easy is it to turn assets into cash. So what's the most liquid current asset? Short-term asset is what current means. Well, cash is the most liquid. You can do anything with cash that you want to, whereas stock, to get cash from stock, it obviously indicates you've got to sell the stock. So if there's any problems with the stock, if it's perishable goods, which is food, edible goods, it can go out of date, so you can't sell. Well, it's unlikely that you're going to sell food that's out of date. So it's the least liquid. So the order of liquidity, it's the least liquid to the most liquid in order. So you've got stock, which is, I never really write this, is for the video, closing stock. I get students that get confused and they write opening stock. But it is the closing stock which is required. If you get stuck with what stock to use, just remind yourself of the date. The date of this is the end of the financial year, and it should tell you that in the outside of the trial balance. So the closing stock value you're using, which goes in the middle column, the value for that is always outside of the trial balance. It's never in the trial balance. In the trial balance, you'll find only opening stock. Next we've got debtors, trade receivables, which go in, move it to the left because there is an adjustment to make. The provision for doubtful debts, this is the new provision for the period, needs to be taken away, and you would get new debtors. Again, no name for it, but it's just debtors less provision, which is new debtors. Now we go on to another element here, which is we've got prepaid expenses. Now again, I will go through this in another podcast, but to prepay expenses, that is a current asset. I'll briefly mention why. As soon as you pay an expense, if you pay an expense before the expense is the period of expense is incurred, you're paying sooner than you need to, then that payment's not being realised. So that means that although maybe the electricity company who you prepay, they have your money, they don't own it until the timing of that expense has occurred. So if you're paying in January for February, if you're paying in January for January and February, so you're prepaying a month, then they actually have your money, but you as a business still own that money even though they have it, because the timing that you've paid for, the period you've paid for, it hasn't actually arose yet. So in February, when it comes to February in that example, that's when they then own that money. The opposite of that is looking at income. So income in arrears, is income that is still outstanding. So the best way of thinking of the income, this one, is to think of it as income in arrears is money owed to you, other revenue owed to you. So that's similar to a debtor, because debtors owe you money. So income in arrears, think of it in the same way as debtors, but we could treat them separately. Bank obviously is a value, which we will have, and then cash as well. Cash is a value as well. I don't know why there's gaps between this. And then obviously you've got cash. So the layout here, we use the middle column quite a lot. We move to the left to do the adjustment for the debtors and take off the provision, bring it back to the middle, and then we can sum the total current assets, which is here. Okay, moving down. So now we've got a total here. We don't want to put all of these values for current liabilities in the middle there, because then it's blocking the totals. Now, it's not a rule, but it's just for being tidy. We tend to move to the left, bring the relevant value to the middle, and then we can deal with that number and this number. So current liabilities, short-term liabilities, bank overdraft, we've got creditors, trade payables, loan due within a year, accrued expenses. So again, compare this, accrued expenses whereas is a current liability, whereas prepaid expenses is a current asset. Income in advance is the opposite of income in arrears. So accrued expenses, basically we haven't paid enough compared to how much we do owe, so that's an accrual. Income in advance is money that's been paid to us before the timing has come about. So that could be someone, obviously if we rent out our building to someone, they've prepaid us if you wish. So income in advance. The reason current liability is we have their money, but they don't have the benefit of that payment. So we are liable to give them, we are either liable to give them whatever they're paying for, or we give them that money back. So that's why it's a liability. Add these up. Again, they don't have to put brackets around them, but it's just showing that it's going to be deducted from the current assets. Add up the current liabilities, total here, and then we're now in a position to move to the far column. So we've got two totals: total current assets, total current liabilities. Now, famously, you do this in business studies as well when you're working out some ratios. Current assets minus current liabilities will give you what's called working capital. It's all called, some of you may know this, it's also called net current assets. So net current assets, so net means different between the current assets. So that's, you have to put both, just put one of them. Working capital is, again, a useful term. And the value, this current assets minus current liabilities, will go here, the far column. And it is it's under, it's further down, but it is under the value for your total fixed assets net book value. So where do we go next? Okay, so I'm going to do with long-term liabilities as well. Obviously, it's a full layout. At this point here, so what is this value called? Well, it doesn't get a name if you have long-term liabilities. So in some questions you may not get long-term liabilities. So let's think. If you don't have long-term liabilities in a question, then this value here, whatever it is, will be the last value in the top section of the balance sheet. And as you can see further on, it would be this. It'd be called net assets. That would be net assets in our long-term liabilities. So if we have long-term liabilities, which is non-current liabilities, say an 8% loan due after 1 year, the clue is after 1 year, so it's long-term, then we stay in the far column, the last column, and whatever the liability is, long-term liability is deducted from that subtotal value. And we get a final value, which is, in this case, net assets. Okay, so if we didn't have long-term liabilities, that wouldn't be there, obviously, and then that would be net assets. Okay, just to, a point there, you think to yourself, if we told 8% loan, what does the 8% mean? Well, the loan would be whatever the value is there. 8% means it's the annual rate of interest. So if that was 100,000, then it'd be 8% of 100,000 is the interest for the year. Just a point there. Some students do ask, what's 8% mean in when it says 8% loan or 10% loan or something. So that's the percentage interest. So that's net assets. Now, according to the accounting equation, assets equals capital. Okay, obviously you've got liabilities as well in there. So whatever net assets equal, you must get that equal to capital down here. Now, it's strange that it hasn't got a name. This is closing capital at the last balancing value. This will balance with this, and obviously if it doesn't balance, then there's some mistake. But we need to get it to balance. So what is this section here? Very small section here. You can have this. I'll just edit this a little bit with you. Capital. You can have, it used to be called finance by, which they don't tend to use now. So I don't really give it a heading. I just start with capital. This is the opening capital for the period. So this is starting capital, which would be value in the trial balance. Whatever the profit or net loss was, which is in the layout I've just shown you, whatever it is for the year, will go in here. If it's a net profit, it's added to the capital to give a subtotal. If it's a net loss, it gets brackets, and the number, whatever it is, if it's a net loss, is deducted from the capital. A net profit will increase capital. A net loss will decrease capital. Okay, and then you've got drawings, obviously, to take out. And remember I said drawings, all drawings. So if there's drawings in the trial balance, already existing value, then that means that it's usually it means drawings of money. It can mean stock as well, but whatever the value is in the trial balance needs to go in here. But if there is an adjustment for, when I said before, when the owner takes goods out for personal use, that has to be included as well. So increase the value in here and then take it away from the subtotal to get the value. Now, I'm just going to tweak this a little bit because in some questions I've seen obviously there are some extra things you could have. So let's just do this while we're here now. So you can have capital. You could have capital introduced, so that could be in because it's a sole trader we're looking at, that could be a value. So capital introduced, so that's starting capital, maybe more capital going in during the year. We make a net profit, and then we get a value, and then we've got drawings, which comes off as well. So this gives you closing capital, and that is the layout for the balance sheet. Now, looking at some key terms. If we look at some key terms, I've just got my what is what sheet. So here it is. Hopefully you can see that on the screen. This is what, and this is my worksheet. Some students just asked, they just get inquisitive and they ask, how many expenses is it possible to get? And obviously in the exam, you've only got a limited amount of time, so you're only going to get maybe, I don't know, 10 say OCL. AQA maybe about the same or slightly less. It depends on the way they've set the paper. So what I did was I just put a whole lot of terms. There's 2 pages of this, not one. A whole lot of terms down the left-hand side, and then I just want you to see if you can test yourself to see which one is a revenue, which is an expense. So that's obviously helping the P&L. So if it's a revenue and expense, as in like this one here, discounts allowed, is an expense, then it's going to affect the trading or the profit and loss account, because that's where revenue expenses belong. So I've shaded them appropriately. If they're a fixed asset, current liability, long-term liability, or capital, well, they're all shaded dark because they all go into the balance sheet. So you're going to at least hit 2 shaded or 2 with a light because it's applicable. So it's just testing your awareness of where they belong. So look at that on your screen, take a screenshot or download it, or I don't know, copy it down. I don't know how you do this, but just hopefully you can find it useful to test yourself as to what these are. How can you recognize these terms? And that's page 1. I'll go down to page 2, which is here, and that's all I did. So if you can think of any more, obviously do drop me a message, drop a post on the YouTube box if you found any more that you can think of, and anything that you've seen in an exam, perhaps not ones that maybe are in an old textbook that is never really used anymore, but something that is relatively useful. Then obviously drop me a message. But try those and see how you get on with distinguishing these terms as to what they are and where they belong. Well, I want to thank you for stopping by, and this has been a podcast from Professor of Accounting, and I hope you obviously enjoyed the podcast and found it very useful. I know the exam is for both exams are tomorrow, which is AQA and OCR. I know this would have this helps for Unit 1, but it will certainly be helpful for the second exam. Obviously there's final accounts in both, so hopefully you find it useful. My email address is there, and YouTube link, and obviously student rooms. So I want to thank you for stopping by, and I'll see you again for another podcast from Professor Accounting. students use as a guide to completing their final accounts. Teachers use this, and an exam board opts for this method, but it's again, there's a few variations between the layout, and there's no prescriptive layout that an exam board expects. So if we just look at this first example, this is only the trading account section. This is for sole trader final accounts, and title is important, so you need to have trading and profit and loss account, or the new title, which is income statement. And you can, in this case, they've got of and the name of the sole trader, and it's for the year period ended, or the period ending, or the year ending, and the date. So for example, the date could be the 31st of December 2011, and the date would go in full. We typically adopt a 3-column working out what's called net purchases. So net purchases, there's a couple of ways of working out net purchases. In this example, it's purchases, and it's got carriage in, which is carriage inwards, and that is the delivery cost on buying or transporting the purchases we've bought during the period to the business. So it's like delivery cost, but it relates to stock coming into the business. So it is a cost of the sale, so it's a positive value. It's added to the purchases. Then there's less purchase returns, so less indicates we're taking away. Purchase returns, goods we've returned back to the supplier for whatever reason, faulty, maybe we've ordered too much, maybe the product's out of date, for whatever reason. So that's the return. So if it's being returned, it's not part of the cost of sale or the cost of the goods sold. So that is deducted. But generally, brackets used in final accounts means to take away, to deduct. So you'll see in a moment I have another layout, which is my preferred layout, which is a bit more detailed. That obviously uses, it would use brackets if it was written, but if it's typed, then depends on what you're using. If you're using Excel, sometimes you type a number and it doesn't take brackets. So we've got sales, we get the sales returns, or the returns inward, and that gives us net sales. That's the top section complete. Then we start with opening stock, and this section is the cost of sales. It's not written on here, it'd be on my layout, or the cost of goods sold. So the first element is the opening stock, and that tends to go in the middle column, or it is in this example anyway. Purchases next, and what we're doing while we move back to the left column is we work approach in terms of the numbers, and the column on the left, which has got all the details, and we just start at the very top with sales. So there's no correlation between debits and credits in the final accounts. In this stage, we just use the values from the trial balance in terms of debits and credits, but there's no debits and credits in the trading account or any other section of the final accounts. So sales are our first value, and we put it into the far column, the third column. We then take away sales returns, or returns inward, which is also called, and that goes next. And we tend to, when there's a deduction, we use brackets to illustrate that. Brackets, parentheses, can mean minus, it can mean deduction, it can mean negative numbers, so we've got to be careful what it does. Learn Accounting Podcast by Professor Accounting. This is episode 7, Income Statement, Trading and Profits Account Layout. Let's start first looking at gross profit and net profit. First of all, gross profit is calculated in the trading account, and it is the excess of sales revenue over the cost of goods sold in a period. The trade account is the top section, the first section of the income statement, and when we calculate net profit, this is calculated in the profit and loss, which is the second section in the income statement. Net profit is what is left of the gross profit after all other expenses or overheads have been deducted. Let's look at this layout first of all of the trade account. Now this is only one example, which generally